Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenivek on Bloomberg Radio.
I'm typing in CRYP Go on the Bloomberg terminal, Carol, and I'm seeing that Bitcoin is up above 92,000. And it's at right now up about 6.7%.
Yeah, that's today. But as you know, the narrative around Bitcoin has been a sharp pullback. We've seen that in Bitcoin prices over the past month or so. It is punishing really the most speculative corners of the cryptocurrency market. And the latest casualty is American Bitcoin Corporation. Shares of the crypto miner, which is co-founded by Eric Trump, lost more than half of their value in less than 30 minutes today, triggering some repeated trading halts. So we want to get a little bit more on what's going on.
You're welcome, Monique Malima. She's equities reporter for Bloomberg News. She's in the Bloomberg Toronto bureau. Monique, help us make sense of what's happening to American Bitcoin right now, down 36% as we speak on a day when Bitcoin is actually higher. Why are we seeing so much pressure on American Bitcoin today?
Yes, so American Bitcoin, they're a Bitcoin miner that was spun out of Hut 8 earlier this year, and they've also been seeing declines throughout the year as Bitcoin prices have fallen. Like you mentioned, Bitcoin prices have been pressured recently. They're, even with the gains today, still down close to around 30% from their highs they saw earlier. And for Bitcoin miners like American Bitcoin, that weighs a lot on them because they make most of their revenue through either holding or selling Bitcoin. So when the prices go down, they're going to go down as well. And we've seen that they've actually underperformed Bitcoin over the past couple months. Some of the other things that are
wait, let me just jump in here though. Why the disconnect? Because my gut would be that with Bitcoin going back and bouncing up, mind you, the trend that we've seen as of late has been a lower one. But with a bounce up today, why wouldn't shares of American Bitcoin also be higher?
So American Bitcoin also has some other factors weighing on it. Part of it is that, for other Bitcoin miners, they've diversified. Some of them are looking at AI data centers and other opportunities to kind of get out of just Bitcoin. But for American Bitcoin, there are also some specific pressures today. Eric Trump posted earlier on X that the company had an unlock for some of its shares today. So that might be pressuring as well. And you also have to keep in mind for American Bitcoin, they have a largely retail trader base in terms of their investors. And that can make shares a lot more volatile to some of the things happening in markets or changing sentiment. And we've seen that crypto sentiment right now is a little more negative.
Yeah, I think that's absolutely fair to say. Still a lot more positive than it was yesterday. A little bit of a rebound. We're seeing a little bit of a floor now that's above 90,000. What do the folks you talk to in the crypto community say to you about sort of the next catalyst or the next ceiling or floor to watch for?
Yeah, so in terms of the next catalyst, people are really hoping to see the market structure bill pass. That's being considered by the U.S. Senate. That would give some more clarity around kind of the crypto industry as a whole and the regulations surrounding that. So they see that's a potential catalyst. There's also just needs to be better sentiment in the markets in general. We're seeing crypto isn't just moving off of its own prices in terms of tokens. It's being affected by the broader macro environment of more risk off in terms of investors right now. And, if we do see more interest rate cuts going forward, maybe investors would also feel more confident, analysts are thinking.
So are we seeing, though, I'm just trying to think of some of the other miners that are out there and maybe not apples to apples. I mean, I'm looking at Strategy. It's actually up today. But are other miners being hurt as well?
So Hut 8 is being hurt today, but that's because they still are the majority owner of American Bitcoin. So their shares are down quite a bit, more so off of what's happening with American Bitcoin itself. But like I mentioned, there's some specific factors to American Bitcoin because they did have some shares unlocked today from some early investors that often can weigh on crypto companies, especially ones that have large retail investor bases that can be a little more volatility added in because of that, because they're moving a lot off of sentiment.
So insider selling?
Not necessarily that the insiders are selling. It's that there's been an unlock, so they have the opportunity if they choose to sell. But we've seen in past for crypto companies, we saw this with SharpLink as well earlier this year, that when there are unlocks, that those shares can often then go down because of some of those retail investor fears that, if the early investors can now sell, maybe they'll choose to. So then they're thinking, maybe we should get out before they do.
Yeah, one thing we should note is we have spoken to Eric Trump several times over the last few months. He told me in September that he was committed to the company. He owns about 7.5% of it. And then, Carol, he reiterated to us just in the last few weeks that he's still committed to the company and he hasn't sold any shares and will not be selling any shares anytime soon.
Yeah, definitely committed and certainly defending the idea of Bitcoin. But that is true of like many folks who are within the Bitcoin industry. And we've got a story on the Bloomberg too that talks about like get ready for like a tremendous rally again and a bounce back. So we definitely see this, that what can be a volatile trade. I just want to look ahead real quickly. Just got about 40 seconds here, Monique. We've got a Fed meeting next week. If we get a rate cut, the gut response would be that any kind of speculative, high valuation, type of asset should rally. Should we assume that will be true along the crypto universe?
Yes, there are some analysts that are saying an interest rate cut would help crypto. We've seen some more risk pullback in terms of investors recently, as there were fears earlier that maybe there wouldn't be interest rate cuts or uncertainty around the path for interest rates going forward. So they're hoping that once people have a little more certainty around kind of the macro environment in the U.S. and where the economy is headed, then they'll feel more confident being in some of these riskier assets like crypto.
All right, we're going to leave it. Monique, thanks so much. Monique Malima. She is equities reporter at Bloomberg News, joining us from our Toronto bureau. Again, as we look at American Bitcoin, we did see some halts in the trade today, but this stock, I'm assuming it's one of your decliners today.
Yeah, it is. Down right now by 36%, but earlier in the session it was down as much as 51%. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I think it's fair to say Michael and Susan Dell took the Giving Tuesday pledge seriously. They're going to give 25 million American children $250 each to jumpstart an investment account for their futures. It's a $6.25 billion gift. It builds on the Invest America initiative, better known as Trump accounts. It was created earlier this year as part of President Donald Trump's One Big Beautiful Bill Act. Here's President Trump at the White House a little earlier today.
An investment's going to be made. That investment's going to continue to grow, we hope, right? We hope. And but it will. And they'll feel like Michael Dell someday. But at 18, they'll have a lot of money, a lot more money than they would have had, and potentially a lot of money.
I got to see the power of compound interest early in my life, and that has brought me here to this moment, and hopefully will inspire that kind of opportunity for many more young people in this country.
That was Michael Dell earlier today. Right before that, that was President Trump, both from the White House, talking about this $6.25 billion gift. I want to bring in Biz Carson. She's a journalist based out in our San Francisco bureau who wrote about this donation, about this gift. She joins us from San Francisco. Biz, what was it that got Michael Dell's attention with these Trump accounts? You spoke to him ahead of this announcement.
Yeah, I mean, I spoke to him yesterday, and he's very excited about investing in American children. It's been something that his foundation has been doing for 26 years, but he kind of faced this philanthropic problem. It's a good problem to have, but how do you give away billions of dollars? And his foundation has done everything from grants to scholarships, but this Invest America Act, the Trump accounts, offered a new venue, a new way for him as a philanthropist to give money to a large, percentage of American children. He was thinking of starting with Texas originally, but it grew in scope, and that's how he ended up with a $6.25 billion gift that's going to impact 25 million American children.
Yeah, it's massive. Tim and I have been talking about this. I think everybody's been talking about this story all day, Biz. And so how does it all work? where's the fund registered? Where's the fund managed? Like, how does it work? And who specifically is really going to be able to access this?
Well, it helps that this is officially a government program, because that's been a philanthropic problem of how do you pick a nonprofit? How do you make sure this is actually getting in the hands of the people who they plan to support? So under the Trump account, and part of the big, beautiful bill is that this is now a government program that's going to be handled through the U.S. Treasury. And so for the Trump accounts, those are going to be seeded for newborn children that are born between 2025 to 2028 with $1,000 from the government. And those will be opened automatically after the child is born. Then for all other children under the age of 18, they're eligible to activate their account next year, starting after July 4th, and they can open an investment account. And Dell's gift, he's going to be giving the money to the U.S. Treasury. And so for children who are not eligible under the newborn government credit, but are still under the age of 10, and in certain zip codes where the median income is below $150,000, the U.S. Treasury will be dispersing the money for those accounts as well, coming from the Dell gift. And that's going to be $250 to every child under the age of 10 who signs up and is eligible in these zip codes.
Certain zip codes. How do we know?
Certain zip codes.
How do we know which zip codes?
I don't know. That's a question I'm trying to figure out, too, to figure out if I'm in that. It's going to be a question.
I think a lot of us had the same question early this morning when we saw this.
Yeah, he said he was going off census data when we spoke yesterday, and that in his research, his foundation takes a very data-driven approach to everything, that looking at zip codes where the median income is less than $150,000, he believes he's going to hit 80% of children in that 10 and under bucket. So it's going to be reaching 25 million or 80% of children under the age of 10. So the majority of American children.
So is the money, when it's taken out, is it taxed? Is it taxed as any investment? Or I'm just curious that how is it considered? Like when a student or an individual becomes 18 and can actually tap into it?
Yeah, the money is going to be taxed as, I believe it's ordinary income. So these are tax-free gifts going in. And once they turn 18, they can use the money for education, but they could also use it for home ownership, startup entrepreneurship costs. So it's a little bit more flexible than like a 529, for example. A lot of this tax stuff is still being worked out. I think accountants will be busy in the next year or so trying to understand the implications of all of this. But it's designed that the money is accessible only after the child turns 18. So
there's an annual contribution limit on these Trump accounts of $5,000. It can be set up for kids under 8 starting on January 1st. As you mentioned, Biz, it cannot be touched until individuals are 18. But then it's distributed to holders at age 31, regardless of whether or not they've taken anything out?
I believe so, but like I said, they're still working out a lot of the details.
Well, I think it's fair to say nobody really knows all the details about this because they are still being worked out. You did mention it's more flexible than a 529, but it's not totally flexible. You mentioned some of the things that the money can be spent on. What happens if you don't spend the money on those things? I'm not entirely sure. I think if you're taking out the money to spend it on other things, then you do have to pay the early penalty. Okay, that's what it is. So you can remove it penalty free. And there's a lot of tax debate around these accounts right now because are they better than a 529 if you're going to use it for education? Maybe not. Are they better than other, options available for children if you're looking to invest? But I think the difference with these accounts, and that's what Trump and other people are touting, is that because they're automatically open for newborns, because they're going to be easily activated for other children, is that they're hoping to reach children who have never had a savings account in their life. And so this is going to unlock something different for them than perhaps a financially savvy, higher income household that's looking to kind of maximize their tax advantages. I mean, so you could technically, you're saying at 31, or so we believe, at 31 you're going to have to, if you haven't used it, I guess take the distribution, but you could roll it into another investment account, I guess, if it's about kind of like wealth creation too, right? Which is something we talk about, socioeconomically. Like the access is not the same for people in the higher income strata versus the lower OAs, right? The opportunities to create wealth. And so maybe this is something that helps people get to that point, create some wealth.
Exactly. Many children don't have savings accounts at all. There will be children who have them maximized with accountants to the nth degree. But this is really for those children who don't have that financial knowledge to have a savings account. And then along the way, equip them with financial literacy, because they'll be able to look at it and say, look, I own part of Apple stock or something like that through my index fund. Can I,
Right.
what is happening with the company?
Yeah.
What do I need to learn about this? They can see their money going up and kind of understand compounding, which is a concept I'd say most kids under 10 don't understand today.
Biz Carson, thank you so much of Bloomberg News. This is Bloomberg Radio.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Carol, let's talk a little bit about San Francisco.
Let's do that.
Okay, just a few years
story.
ago, it was a symbol of post-pandemic urban doldrums. Yeah, it's a great story on the Bloomberg. Now it's one of the hottest housing markets in the country.
Yeah, we're talking about an area where it's really been hit by the AI boom.
Yeah, it's reignited demand for high-end homes among buyers cashing in on soaring startup valuations. Now, in addition to the new influx of tech money, the city's seen a turnaround in crime, recovering office demand and cleaner streets. Mayor Daniel Lurie took office in January with a pro-business slant. He attracted wealthy donors to the cause of improving San Francisco's fortunes.
Remember, everybody was like, nobody's coming back to San Francisco. And here it is.
Yeah, of course.
It's coming back.
Well, closer to home for us here in New York, there are questions about the status of residential real estate under the mayor-elect Zohran Mamdani. He takes office in January. Wondering what Louise Phillips Forbes is seeing. She's a real estate broker with Brown Harris Stevens. She's been in the industry for more than 3 decades. She's got just around $6 billion in transactions. She joins us here in the Bloomberg Interactive Brokers studio. How are you?
I am great. So happy to be back, Tim, Carol.
So last time we spoke to you was pre-election. Mm-hmm. Now we know who the mayor will be.
Yes.
There was a lot of hand-wringing ahead of the election about people who would leave the city if Zohran Mamdani won.
They haven't left.
They haven't left?
Just to be clear,
Okay.
They have not left.
Are you seeing any? What are you seeing in terms of real estate right now? What are you hearing?
I mean, listen, we've just gone through an unprecedented time where we had a government shutdown for 44 days, which is the longest we've seen.
Yeah.
And in our housing market here, we had a lull. But honestly, the last 3 weeks, we have been on fire. Multiple bids in many cases. The days on market are shortening. This only lagging sector is between $4 and $6 million, which is not necessarily first-time buyers.
Yeah.
But it's strong, and I'm feeling like we have an energy that we should expect a strong indicator for 2026.
So $1 million to $4 million doing very well.
Very well.
Above $6 million doing well.
I mean, it's not that it's not happening; it's just lagging, especially if it needs work. But that's not new information. The cost of doing renovations, etc.
Wow.
So what does that $1 to $4 million activity tell you?
It tells me that people are not waiting for interest rates to drop anymore. That, if I look at the key indicators for 2026, we're going to have a stronger growth, probably 4%, 4 to 6%, they're saying, for increase in the pricing for the median homes. We're going to have outer boroughs like the Bronx and Queens seeing more advancement and probably a quicker pace of growth to New York City just because of affordability and first-time buyers moving there. I think people aren't going to wait for the interest rates.
What do they say? Marry the home, date the rate? What do they say?
That's my line, yes.
What do you say?
Marry your home and date the rate.
Okay.
So buy more today than less tomorrow.
Well, I went by that, and I feel like things are getting a little close.
Wait, you bought a place without me?
I did, yes, believe it or not. I didn't want a conflict of interest.
No, I love that. No problem.
But it
I'm
feels
happy
like
you're settled.
The rate, we've been dating this rate for a long time, thinking that rates were going to fall. Feels like we're kind of engaged at this point. We might end up getting married, but I'm going to have to refi at some point.
Yes, but then
because
do it
it's
when
an
you do
arm.
it. But that's okay. The bottom line is that, hold the value, especially when rates are a little bit higher, the values are lower. So that when they drop, and again, rates it continues to be baked into the market. Mm-hmm. So it sometimes it doesn't necessarily mean that your rates are going to actually drop.
I'm glad you said this, because if you were joining us maybe 3 weeks ago, we'd be talking about the idea of a 50-year mortgage, something that Bill Pulte of Fannie and Freddie floated a few weeks ago. And I think at the end of the day, if you have a longer mortgage, it means, one, you're paying more in interest, but I don't think that's the story. I think the real story is homes are bought on monthly payments, and what you can afford. What you can afford in a monthly payment. So if the monthly payment goes down, that could actually increase the price of these homes.
Absolutely. And that is what, if you look at what things traded in 2021, which was a recovery market, we had 2.85 to 3% interest rates, and those homes had massive growth. And if you think about what happened outside of the city, they were 35% increases in evaluations.
Yeah. Right.
So
as people moved out, right? They wanted to get away.
It's supply and demand. And that we're going to still continue in 2026 to have supply and demand to outpace. We're going to have more demand than supply will be there.
Well, more demand than supply.
For sure.
We always talk about affordable housing. I mean, I don't know. Do you anticipate something different with this incoming mayor?
I think that I mean, I did not necessarily vote for him. However, I believe he has great intentions. I believe that he believes in what he believes in. Yeah. And I think that he has an opportunity with the charter, the city. In our election, we had 4 city charter changes that were all passed, which are an opportunity for him to pave a way for a number of things. Fast tracking affordable housing. It doesn't go through the bottlenecking and the political sort of opposition. It's no longer going to, if it's 100% affordable, it will get passed in a very steady, quick way. And when you're looking at the ability to reverse those charters, there are a number of them that are all about fast tracking and simplifying. You want to say something?
Yeah, I do. On the affordable housing thing that Carol was mentioning, what we've spoken to quite a few people about when it comes to housing affordability is it's still a question of supply and demand, and whether or not new homes get built here in the New York City area over the next few years. Is there a realistic assumption that will happen under this next mayor?
I think that they are tools that are at his disposal to overturn denials through a 2-to-1 vote. That is a truth. We know that if there is collaboration, it's a time for not to have confrontation, but collaboration. And I think he has an opportunity to bring those people. If you notice, some of the things that he platformed and preached on have quieted a little bit because he knows he has to get things done.
Well, it's so rough because I think a lot of people understand it's important that we provide a variety of housing for everybody who lives in a major city, right? And make it affordable. At the same time, builders are not going to build unless they can make money. The
incentive is there.
Right. So unless you get that public-private cooperation or something, right? Like unless
the policies towards tax, towards what we used to have 421A, which would give the opportunity for a lowered, you get compensated for improving your land. Those are things and policies that will mobilize the private sector.
The other thing I would say is let's improve wealth for everybody, and maybe people can afford more homes and you don't have to do so much affordable. Louise, we've got to run. Thank you so much. Louise Phillips Forbes, real estate broker at Brown Harris Stevens.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Can you just focus on driving? Focus on the road.
Why would I drive fast?
Because I'm asking you to.
Just take your place in the driver's seat.
Just drive, baby.
Driver's seat.
This is the Drive to the Close.
Where we're going, we don't need roads.
On Bloomberg Radio.
All right, folks, we're just about 19 minutes away from the closing bell on this Tuesday, December 2nd. Carol Master, Tim Stanovic live here in our Bloomberg Interactive Brokers studio. We've got stocks, as we continue to say, bouncing around here. We're off our highs and lows of the session. You heard Bill Maloney and Charlie Pellet just talking about the trade. We're up about 0.4% on the S&P 500 as we are driving near the end of the trading day. 297 points, or 0.6% higher in the Dow Jones Industrial Average. NASDAQ 100, a gain of nearly 0.9 percentage point, up 223 points. Flip on over to the S&P 500. Not quite an even split. A few more names to the upside. 278 at this hour, 222 to the downside, Tim, and 3 unchanged. And if you take a quick look at the action in the Treasury trade, just watching those yields as we are now about a week out from the last Fed decision of the year. I'm looking at a 2-year note with a yield of 351, shorter end of the yield curve, most sensitive to what the Fed does next week. And we're seeing that lower on the day in terms of the yield. 10-year note, though, higher, and we're up above 4%, 4.08 to be exact.
I want to bring in Alan Zaffron. He's the co-founder and managing partner of IEQ Capital. He's got about $36.8 billion in assets under management. Alan joins us once again from Foster City, California. Alan, it's been a few months. How are you?
Doing great. Happy holidays, Carol and Tim. Thanks for having me on your show.
Happy holidays to you. There's a lot that I want to get to with you, and I want to start with private credit. I know that in the notes that you shared with us ahead of this interview, you have an outlook for the fourth quarter of this year, and you argue that private credit remains a compelling core allocation, offering material excess yield relative to public fixed income, even as interest rates decline for floating rate bonds. Did you write that before or after the concerns about private credit that have emerged over the last few weeks?
Both. I would have written it before, and I'd still write it afterward. And the reason is, in the event you're really invested in a truly diversified private credit fund or several funds where you have literally hundreds upon hundreds, if not thousands upon thousands of outstanding loans, historically, these private floating rate loans have terrific risk-adjusted returns. And even if eventually defaults go up a bit if the economy softens, given their floating rate, their senior, you end up collecting the predominance of your capital back even if there is a default. Over time, the excessive amount of yield you get relative to public bonds historically does well. It would be different if you told me you're making a handful of loans to illiquid or poorly capitalized businesses. So you need to be very prudent about which underlying fund manager you allocate your capital to, and you want to make sure those companies have very large balance sheets generating EBITDA, positive cash flow. Those are the kinds of private credit loans that we're very comfortable owning.
Hey, how do you think, Alan, hello, happy holidays to you too.
Happy holidays.
How do you think, though, if we see kind of mass adoption of private credit, private equity throughout 401k and investment retirement plans, how that impacts that market? And I'm just trying to understand, because first of all, we know it creates a whole new bunch of capital, right, to invest. But I wonder if that leads to less lucrative deals, messy deals, a lot of money. You know what I mean? I'm just trying to understand how that might ultimately play out.
Yeah, I'm going to give you sort of a 3-part answer. Part one is, albeit it's great, it's the democratization of alternative investments for all investors. You're right. There's going to be more capital, more demand going into a set supply of loans. So all things equal, the spread over public bonds will be a little lower. It'll be a little less attractive. Secondly, and more challenging, is many of the ways in which these private loans are offered are in what they call open-end funds, and they offer you the ability to have monthly or quarterly liquidity. And the secret behind that is a manager will limit probably no more than maybe 5% of the total fund value to be liquidated, let's say, in any quarterly basis. So if there was headline risk and bad news came out and a lot of investors panicked all at once, a manager could theoretically gate or limit how much any single individual could get out of the fund in any quarter increment, even though it's advertised as quarterly liquid. So what you need to understand is, if you are investing in an open-end fund as a client, as an investor, you need to understand that it's really more of a permanent allocation of capital. And even though it may pay cash flows monthly or quarterly, you need to recognize that it may not be as liquid as advertised. And then the third part of my comment is, in the event investors panic, they can create an oversized negative reaction in price, not really reflective of the ability of the companies to pay their loans. But if enough people all want to get out at once, you're going to have to live through the cycle till prices reflect back to a normal point in time. So if a lot of somewhat less sophisticated investors plow in because they like a high yield, they run the risk that they will get gated somewhere along the way. And they need to understand that they have to hold that asset class through a full cycle to really understand that it has created a better, higher risk-adjusted return than conventional bonds. But along the way, it could be a problem along the way, potentially. And that's why you want to be in a very well-allocated set of loans with highly capitalized and cash flow positive companies.
Sounds like you're going to have to be much more particular and be very careful, right?
That's it. It's buyer beware. It's no different than equities.
Yeah.
You need to understand credit is actually positively correlated with equities. So unlike treasury bonds, private credit goes up and down in alignment with the direction of stock prices. So you get paid to take this extra risk, but you're going to bear extra price risk along the way.
Okay, Alan. So are we done with private credit, Carol?
For the moment.
Okay. I do want to move on to some other things. We're not going to have time to get to everything, but I guess our second favorite thing to talk about right now is sort of the where we are if this were an AI bubble. And you make the case that we're not quite at 1999 yet, but we're getting a little close.
I think that's probably right. I mean, look, just to tell you how hard it is to predict, Alan Greenspan, who was the Federal Reserve Governor in the late 1990s, made a comment about markets can exhibit irrational exuberance. He was basically saying things feel overvalued. Tim, do you have any idea what date Greenspan made that comment?
I think that was like 95, right?
It was in December of 1996, and the S&P 500 it doubled from the point he made that comment before the market peaked in March of 2000. So, and he's theoretically the most knowledgeable person on the planet. So anybody's ability to pinpoint a top, it's a fool's errand to try. What I can say is this: the companies themselves, largely, certainly the hyperscalers, have significant balance sheets and still generate profits and cash flows. What's interesting, if you look under the surface, most recently, you're beginning to see a bit of dispersion amongst the performance of various AI players. So as an example, more recently, businesses somewhat tied to Google's AI Gemini 3 product tend to suddenly be performing better, and suddenly companies tied to the OpenAI ChatGPT tend to be performing recently a little less well. It's telling me investors are starting to discern slightly more both the underlying quality of the underlying AI, and secondly, the strength and balance sheets of these businesses to deliver what's being promised. And so those are the early stages of markets being critical, and that's healthy, because if we just have irrational exuberance, it's going to be a big bubble. We're not there yet.
All right, we're going to leave it there. This was fun. Happy holidays if we don't catch you before the end of the year, and Happy New Year. Alan Zafran, co-founder, managing partner of IEQ Capital, joining us from Foster City, California.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.